If you follow metals, macro, or really any corner of the financial markets, you need to pay attention to what just happened in silver. And seriously, don't scroll past this, because this is one of those moments that teaches you how markets actually behave under stress. Silver just rocketed nearly 10% in a single day, clawing its way back toward $86 an ounce, only days after suffering one of the most violent crashes modern traders have ever seen. We're talking about a 27% collapse in one session, another hard drop the next day, and now, boom, a vertical rebound. So the question you should already be asking is simple. Is this the start of a recovery or just the market catching its breath before the next punch? Stay with me, because if you understand this move, you'll start recognizing these patterns before the crowd does. Before I explain what caused this, let me teach you something most investors never fully grasp. Markets don't fall smoothly, and they definitely don't bottom politely. Real bottoms are chaotic. They're emotional. They're mechanical. Think of a crowded theater where someone yells fire. People don't walk out in orderly rows. They stampede. But here's the part many people miss. Once the exit gets jammed and everyone who was going to panic has already run, the pressure suddenly disappears. Prices don't just stabilize. They often snap back violently. Here's what you need to know about oversold conditions. They're less about value and more about positioning. When too many traders are leaning the same direction, the market becomes fragile. One shove and everything tips. That fragility isn't weakness in the asset itself. It's weakness in the structure of who owns it and how they own it. If you've got 1,000 people all standing on the same side of a boat, you don't need a wave to capsize it. You just need one person to shift weight. If this is making sense so far, drop a comment below and let me know you're tracking with me, because what comes next builds on this foundation. So what does that tell us? It tells us that violent moves, both down and up, often have more to do with the mechanics of markets than the fundamentals of the asset. And that's critical to understand right now. Now here's what's actually happening beneath the surface. Last week's crash wasn't just fear, it was structure. Futures margin requirements jumped, which basically forced leveraged traders to put up more cash immediately or close positions. And when traders can't meet those calls, they sell. Fast. That forced liquidation becomes a chain reaction. Selling pushes price lower, lower prices trigger more margin calls, and suddenly you've got a cascade. Let me break down the sequence. First came the leverage unwind. Funds dumping contracts because they had no choice. These weren't people making strategic decisions about silver's long-term value. They were getting phone calls saying post more collateral or we're closing your positions. Second, liquidity vanished. Buyers step away during chaos, which makes every sell order hit harder. When there's nobody on the other side catching the knife, prices freefall. Third, volatility spikes, which causes risk models to automatically reduce exposure. Machines selling to control risk. Humans selling to stop the pain. Here's what's wild about this. The rebound doesn't require optimism. It only requires the selling to stop. Once liquidation peaks, something flips. The forced sellers are out. They've already puked their positions. They're done. And suddenly the market's looking around going, wait, who's left? Investors who are waiting on the sidelines start seeing opportunity. Was silver really worth 30% less in 2 days? That question alone brings in dip buyers, not dreamers, professionals, capital that hunts dislocations. But here's the part that should make you nervous. Relief rallies can look incredibly convincing. They're fast, aggressive, almost theatrical, and they often happen inside broader periods of uncertainty. You get this sharp bounce that feels like vindication, like the market's telling you everything's fine now. But sometimes, and I need you to hear this, sometimes they're just the market catching its breath. Now let me show you what most people are missing. Today's surge may say less about bullish conviction and more about mechanical pressure easing. When the forced sellers are gone, price floats upward almost by default. It's not necessarily because new bulls are charging in with conviction. It's because there's no more panic weight pushing it down. Think of it like holding a beach ball underwater. The moment you let go, it rockets to the surface. Not because the ball decided to be optimistic, because the pressure disappeared, and that mechanical nature matters. Because it means the rally could be real in the sense that it's happening, but fragile in the sense that it hasn't been tested yet. The buyers stepping in right now, are they committed? Or are they just scalping a technical bounce? This is the exact same playbook markets have run before. Think back to the 2020 pandemic panic. Gold and silver initially plunged as funds liquidated anything with a bid, only to rebound sharply once that wave passed. I remember watching those moves. Gold dropped from $1,700 to $1,450 in about 2 weeks. Everyone was freaking out. And then what happened? It ripped to $2,070 over the next few months. Not because the virus got better, because the forced liquidation cleared. Or the 2008 financial crisis, when commodities crashed not because they lost long-term relevance, but because leverage had to be purged. Oil went from $147 to $33, not because the world stopped needing energy, because margin calls were brutal and funds had to raise cash anywhere they could. Even the nickel shock in 2022 showed how positioning can overwhelm fundamentals overnight. Nickel doubled in a day, trading got halted, positions got unwound. Complete chaos. Zoom out and you see the larger story. Markets overshoot in both directions. Always have. Probably always will. When positioning gets extreme, reversals get violent. The reason I'm walking you through this history isn't to predict the future. It's to show you the pattern. Forced liquidation creates bottoms that feel terrifying in the moment, but look obvious in hindsight. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this bounce fade just as quickly? Absolutely. Reflex rallies sometimes lure investors in before another leg down. We've seen it before. You get that first pop, people rush in thinking they're buying the dip, and then the market rolls over again. Could there be more structural issues we're not seeing yet? Yes. Could this be manipulation, some shadowy force playing games? Maybe. Here's the thing, it doesn't actually matter whether there's some puppet master behind the scenes. The mechanics are what matter. Blaming shadow forces doesn't help you navigate risk. Structure does. Liquidity does. Positioning does. Focus on what you can control, recognizing when selling is mechanical versus when it reflects a genuine shift in economic reality. Because if you're sitting there thinking someone's out to get you, you're not thinking about what's actually moving price. The truth is, most conspiracy theories are just complicated ways to avoid admitting the market did something we didn't predict. And I get it. It's easier to blame manipulation than to study margin mechanics. But only one of those approaches will make you better. There are probably 3 types of people watching this right now. First, you might be the investor who panic sold during the drop. If that's you, don't beat yourself up. Volatility is designed to shake people out. That's its job. Your lesson isn't regret. It's preparation. Next time you see a violent move like that, you ask yourself, is this emotional selling or forced selling? Because if it's forced and you can stay calm, that's when opportunities appear. I'm not saying catch every falling knife. I'm saying understand the difference between a market that's broken and a market that's being mechanically liquidated. Second, maybe you're the dip buyer who stepped in early, heart racing while everyone else ran for the exits. Your edge is courage paired with analysis. But remember, scaling matters. You don't need the exact bottom. You need survivability. If you went all in at $95 and it dropped to $85, you're sweating. But if you scaled in across $95, $90, $85, you've got room to breathe. And honestly, that's the difference between traders who survive volatility and traders who get wrecked by it. Third, you might still be on the sidelines, wondering if you've missed it. Let me tell you something important. Markets constantly create second chances. What you wait for now is confirmation, stability, tightening ranges, healthier volume. You don't chase violence. You study it. You watch how price behaves after the initial panic clears. Does it hold the rebound zone or immediately retrace? That tells you everything. So here's what I want you to answer in the comments. Which type are you? Did you sell the panic, buy the dip, or wait on the sidelines? And more importantly, what did you learn from watching this unfold? Because that self-awareness is what separates investors who grow from investors who repeat the same mistakes. The universal principle here, no matter which camp you're in, is this. Don't let the violence of the move cloud your understanding of what's actually happening. Price action can be extreme without the fundamentals changing. That's the core lesson. Here's where I stand. I'm not blindly bullish, and I'm definitely not bearish after forced liquidation. I'm conditional. Let me tell you what I'm personally watching. First, I'm watching whether silver can hold above the rebound zone instead of immediately retracing. If it consolidates here, if it builds a base in the low to mid-80s, that would indicate the buyers stepping in aren't just momentum chasers. They've got conviction. Second, I'm watching futures positioning. If leverage builds too quickly again, fragility returns. We don't want to see the same crowded trade rebuild in a matter of days. That would set up the exact same cascade we just experienced. Third, I'm monitoring volatility. If it compresses, that signals normalization. If it stays elevated, the market's still scared. Based on my analysis, this crash and this rebound were mechanical, not random. The deeper fundamentals didn't evaporate in 48 hours. Industrial demand for silver didn't change. Monetary policy didn't shift. The supply-demand story is still intact. What changed was positioning and leverage, and when those unwind violently, prices whipsaw. But once the dust settles, fundamentals tend to reassert themselves. If history rhymes and silver continues consolidating rather than collapsing again, the move that follows could be significant. I'm not giving you a price target. I'm telling you the setup. And the setup looks like a market that just purged a lot of weak hands and is now figuring out what comes next. I'm not a financial advisor. This is not financial advice. Do your own research. I'm sharing my process, my framework, how I'm interpreting what's happening. You need to make your own decisions based on your own risk tolerance and your own analysis. If you made it this far, you're the kind of person who doesn't just react to headlines. You want to understand the machinery underneath. That mentality will serve you well, not just in this trade, but in every market you ever watch. Because markets are ruthless teachers, but they're consistent. They run the same plays over and over. Your job is to recognize the pattern while everyone else is panicking. So stay sharp out there. Think critically. Verify what you hear. And remember, the investors who survive aren't the ones who predict every move. They're the ones who understand the game while it's being played. If this breakdown helped you see the market differently, share it with someone who needs to hear it. Subscribe if you want more analysis like this. And I'll see you in the next one. Stay sharp out there.